Good evening to all the students present across India. Dr. C. Anirvinya today with you to teach exchange rate and its economic effects. Before this, I want to give a brief introduction which will be useful for you. See, you take the prices of petrol, diesel, gold, silver, and many other commodities in the commodity market, right? Steel and other commodities, whose prices are determined on the basis of demand and supply. Okay, if you actually petrol diesel price is fixed morning 6 o'clock. Okay, if you go to any petrol pump, they need to display board saying that today's petrol price is 1 liter is this, and diesel price some 40,000, 50,000 rupees. Commodities prices, okay, are fixed on the daily basis. Okay, prominently gold, silver, petrol, diesel, okay, and many other commodities in the commodity market. And of course, prices of vegetables, fruits are determined on the basis of demand and supply. Okay, and you should remember, that foreign exchange reserves, okay, very important for every economy, right? Now, I'm saying very important for every economy in the sense that, and one country that I cannot take my eyes off, I cannot remove my eyes, is China. China's foreign exchange reserves are something like 2.2 trillion. 2.2 trillion, right? Okay, 2.2 trillion as on today. And India's foreign exchange reserves now currently 640 billion, right? We are inching towards 700 billion, but we are somewhat comfortably placed, okay, with regard to our foreign exchange reserves. 640 billion is our foreign exchange reserves. And when Raghuram Rajan took over, the rock star, I call him a rock star, right? And Raghuram Rajan took over the RBI governor in 2013. India had two major problems. One is high inflation. So I told you in one of my classes, or your teacher might have told you, inflation in India is measured using consumer price index, also known as relative price index. So there are several reasons why India moved to CPI. One reason only I can discuss with you here, because across the globe, every country follows retail price index and consumer price index. And India's current CPI, at the time 2013, India consumer price index is 11%, double digit. And we have something like some 260 to 70 billion foreign exchange reserves. And I told you, Raghuram Rajan killed two birds with one stone. And that's what I'm going to tell you in mid of the course. So foreign exchange reserves are very, very, very important. Okay, I'll just one reason which you are not there in textbook, which you may not require. Okay, why it is so important, I need to tell you. If you are able to remember this point, you write in the exam, but it is not part of the curriculum. Okay, if you're able to remember, you write. Why it's so important, I need to tell you one point. It's not there in PPT, it is not there in your slide also, right? Foreign exchange reserves required for payment of imports and goods and services, for payment of debt by the corporates and government. Okay, so for so for imports of goods and services, we require foreign exchange reserves, and for payment of debt by both government and corporates, right? So we require the third important reason, which is not there in textbook. Please try to understand me, okay? And this I would teach for my MBA students, and same thing I want to teach you here, right? 2008, I think 2008 or 2009, Obama paid a visit to China. Okay, Obama paid a visit to China. Why Obama visited China? Because of artificial currency maintained by China, he's hurting all the countries in the world, including Sri Lanka, Bangladesh, Indonesia, India. All countries are getting affected because of China maintains artificially low value of their currency. So what would happen? China exports are increasing like anything. Okay, and other countries not able to compete with China. Obama paid a visit to China, meeting Chinese authorities, asking them, please revalue your currency. I'm using a term here, revalue. Okay, please jot down. This term will come again, revalue. Okay, revalue, increase the value of your currency. Then Chinese authorities said, shut up, you mind your job, don't tell us. Okay, we know when to revalue your currency, you shut up, you go. So don't play with US, right? US is called Uncle Sham, right? It is the most wisest country in the world, right? That's why they're able to kill so easily Osama bin Laden, and we are not able to capture the terrorists who attacked our country. So they killed Osama bin Laden in their own country, okay? So don't play with US, right? So Obama quietly left China, okay? If you don't want to revalue your currency, what we'll do, we will decrease the value of our currency. We will decrease the value of currency. So what did the Federal Reserve? U.S. Central Bank is called Federal Reserve. It's called Fed. So what did Fed did? Fed supplied so much of money, huge amount of money. Okay, huge amount of money and more than demand, and rate of interest fell to 0%. Rate of interest rate fell to 0%. Okay, the moment rate of interest rate fell to 0%, okay, this topic, please, this is not there, please try to understand. Okay, the rate of interest fell to 0%, capital flew from China, capital flew from USA. Capital, what is capital? This again will teach you tomorrow also. Capital means foreign institutional investment, especially, and foreign institutional investment, foreign direct investment, or foreign portfolio investment. I'll discuss all this. It flew out of USA because rate of interest is 0, right? The short-term interest rate 0, right? So I told you, repo rate in US is called short-term interest rate. It became 0. Capital flew out of USA, and the moment capital flew, dollar started depreciating. Dollar started depreciating. This is what Obama told you, if you don't revalue our currency, we will decrease the value of currency. So he gave a slap back to China. Okay, he gave a slap back to China, to some extent India also. So because they want to hurt both the countries, they want to prevent both the countries from increasing the exports. So the moment US dollar started depreciating, the idea of US government is to increase the exports. That could happen only if dollar depreciates in the world market. So automatically US, so capital flew into which countries? China and India, right? So India rupee got appreciated, and Chinese country renminbi, okay, yuan got appreciated. So my purpose is served. If you can't increase the value of currency, I can increase the value of currency. So rate of interest, short-term rate of interest, US fell to 0%. Okay, now the other reason why Obama government kept 0% rate of interest is US was hit by recession. Okay, US was hit by recession. I want people in my country borrow money from the central bank, from the commercial banks. I want corporates to borrow from the commercial banks. Okay, I want consumption should increase, investment should increase, output should increase, employment should increase, price level should increase. Okay, so and my exports should increase, imports should decrease. Okay, these are all the objectives. Okay, these are all the objectives. So recession. So keeping interest rate 0% is called quantitative easing. Quantitative easing. You can refer in Google also. Quantitative easing. QE. Okay, quantitative easing, where short-term interest rate will fall to 0%. Okay, so and because of their short-term interest at 0, economy started recovering. When economy started recovering, what happened? So the economy started recovering, then they have to increase interest rate, right? So they have to increase interest rate. So the moment there is a whisper, right? There is a whisper that US is going to increase the interest rate from 0 to 0.25, immediately capital fly out of India. Because investors would like to keep their investment in a country called USA, where dollar is a supreme currency. So the moment they took away their money from stock market, dollar got appreciated and rupee got depreciated. And unfortunately, India did not have enough foreign exchange reserves to protect the value of rupee. right? To protect the value of rupee, India did not have enough foreign exchange reserves. So that's the reason why when Raghuram Rajan took over, he killed two birds with one stone. That is, to kill inflation, I kept repo rate high. If I keep repo rate high, I can control not only inflation, I can attract foreign capital. Okay, what is that? We will discuss in upcoming slides. Okay, so I kept repo rate high. So to kill one bird called inflation, if I kill this bird, if I keep repo rate high, I can attract foreign capital. Foreign capital. Okay, this is what exactly Raghuram Rajan did. Okay, now currently again, after due to pandemic, again currently US government again following 0% rate of interest. Okay, currently again US government is again following, US Federal Reserve is again following 0% rate of interest. I'm expecting them to increase interest rates by month of December, okay, or November third week, or at the most December 31st. Okay, Fed is going to increase the interest rate. When again Fed increase the interest rate, even if capital flies out of India, India has enough foreign exchange reserves to protect the value of rupee. This is high quality stuff. Okay, this you don't require. Okay, this you don't require. If you understand this, fantastic. Okay, but it's high quality stuff. This is what I teach for my MBA students, right? This is not there in your textbook. Okay, this is not there in textbook, but this is what exactly happening in the world market. Okay, you should know this is what happening in the world market. Okay, clear. So, and countries like Switzerland, Europe, they followed short-term interest rate below 0%. Okay, below 0% is called negative interest rates. Negative interest rates. Switzerland, Europe, okay, Denmark, they all followed. Japan, they followed negative interest rates. Negative interest rate is what? After following 0% interest rate, still I could not help my economy to recover. I went sub-zero. I want sub-zero. Okay, negative interest rate. Okay, negative short-term interest rate. Clear? This what? Okay. This what introduction. Okay, this is high quality stuff, right? I'm giving just one reason: foreign exchange reserves required to protect the value of rupee if anything happens in the world economy. Right now, India has comfortably placed with 640 billion foreign exchange reserves. We are inching towards 700 billion foreign exchange reserves, and China was well ahead of India with more than 2.3 trillion foreign exchange reserves. Okay, now India is not worried if in case Fed increases short-term interest rate from 0 to 0.25. India is not worried now, because India can protect the value of rupee. Okay, this is an introduction, and this particular point is not there in your book, but I want to give you such a high quality introduction. I want to give you, right? You should know this. So foreign exchange reserves are very important, and foreign exchange reserves are very important for any country. Okay, but in your textbook it is written that country follows flexible exchange rate system, doesn't require foreign exchange reserves. That is not true. Okay, in your textbook it is written that if country follows flexible exchange rate system, doesn't require foreign exchange reserves. Okay, maybe as per, because it's a textbook explanation, whether foreign exchange reserves are very important for any country. And now India has so much of foreign exchange reserves. Now country lacks infrastructure development. Okay, we are pathetic with regard to infrastructure development. China has world-class infrastructure. China infrastructure is somewhat, some aspects they're better than US, right? They achieved saturation. They achieved saturation in infrastructure, but India infrastructure is so pathetic. Government doesn't have enough funds. Government is sitting on high fiscal deficit, and where do we get finances? Where do we get finances to expand our infrastructure in the country? Now there has been argument for last 10 years. Why can't India make use of foreign exchange reserves for infrastructure development? You know what is infrastructure development? Roads, communication, power. Okay, Irrigation projects, everything comes under irrigation comes under infrastructure development. It's called infra. In spoken English, you don't say infrastructure, it's called infra. Okay, India lack infra, India lack infrastructure, and there is an argument that why can't India makes use of foreign exchange reserves to develop infrastructure development in the country. But there are other critics who argue that please don't touch foreign exchange reserves. India needs foreign exchange reserves to pay for its import bill, for repayment of debt by the corporates and government. Please don't touch rupee. Rupee requires stability value, then we require foreign exchange reserves. But there's other different thinking. They're saying that why can't India make use of foreign exchange reserve for the development of infrastructure in the country? Infrastructure is very important in the sense that unless infrastructure develops in the country, supply chain will not improve. Okay, our supply chain have weakened because of our supply chain is weak because of infrastructure. If supply chain is weak, and inflation may operate from the supply side. Inflation may operate from the supply side. Okay, Amul Dairy, right? Amul Dairy not at all impacted by the pandemic. Okay, they're able to deliver the milk with ease during the pandemic despite lockdown because they have a decent infrastructure. A company like Amul is able to deliver the milk. Just imagine for the entire country, right? Supply of goods and services, you require a quality infrastructure, and current government is focusing on infrastructure, but still long way to go. If you don't focus on infrastructure, supply chain will be affected and demand more than supply, price will increase. So in India, inflation is operating both from demand side and supply side. RBI can control only on the demand side by sucking out liquidity. Supply chain belongs to the government of India. Government needs to spend on supply chain. So unless we take care of supply chain, inflation is going to be a threat for this country. This is a beautiful introduction. Okay, please listen to this introduction again. Okay, and you can text me. If you don't understand, you can text me, and I give my email ID. But listen to this beautiful introduction. Okay, so don't read much from the Google. Okay, and I made it so beautiful. Okay, thank you. Okay, we'll continue. Okay, what happened? Oh. So what we are going to study from this, right? Okay, now this one we're going to study. Define exchange rate, describe how it is determined, and appraise different types of exchange rate, and describe the functioning of foreign exchange market, and explain changes in the exchange rate and their impact on a real economy, right? This is what we're going to discuss today, right? Now, what is exchange rate, right? So I'm talking from basic, okay? Beautiful slides are prepared again for you guys. Beautiful slides, okay? My chapters are all slides are very simple, nicely explained. So exchange rate is what? The rate at which one country currency is exchanged with other country, right? So the rate at which one country currency is exchanged with other country is called exchange rate. There are two variants are there: nominal exchange rate and real exchange rate. Real exchange rate. So nominal exchange rate. Okay, when I say nominal exchange rate means I'm not considering the impact of inflation. I'm not considering the impact of price level or inflation. That is how you need to remember. Okay, so how many units of domestic currency is required? 1 unit of foreign currency. So today you require today you require 77 rupees to buy $1. To buy $1. Okay, so nominal exchange rate, how many units of domestic currency you require? I'm not considering the impact of inflation. Please, nominal term means we're not considering the impact of inflation, okay, or rise in the price level. Now, real exchange rate. When I say real, when I say use the word real, we are considering the impact of inflation or rise in the price level. Okay, rise in the price level. So when you're considering the impact of price level, so you are considering the price of domestic goods and foreign goods. So it is a relative prices of goods and services, both domestic and foreign countries. Okay, domestic country and foreign country, or it is a rate at which goods are traded between the two countries. It's rate at which goods are traded between the two countries. So this is a formula you need to remember. Okay. This is a formula you need to remember. Real exchange rate is equal to nominal exchange rate into price of domestic goods by price of foreign goods. Okay. So real exchange rate I denoted as capital E. Nominal exchange rate I had shown it as small e. The price of domestic goods I shown as small p. And upon price of foreign goods I shown as p asterisk. Okay. P asterisk. P asterisk. So this is a formula. Okay. So we are considering relative price of goods and services, both domestic market and foreign market. Now, if real exchange rate is high, okay, if real exchange rate is high, it means if real exchange rate is high, foreign goods are cheaper than domestic goods. Foreign goods are cheaper than domestic goods. If real exchange rate is high, means foreign goods is cheaper than domestic goods. Okay. Now, domestic goods and service. So it means what? People in the country would like to buy goods and services from outside India, exports of goods and services more than exports of goods and services. This is known as current account deficit. Balance of payment, there is an important account called current account deficit. Current account, so current account becomes a deficit. What is current account deficit? Indicates imports of goods and services more than exports of goods and services. Now, if real exchange rate is low, opposite, net exports will be positive and current account is surplus. Okay. So this is what exactly happening to China. Okay. China enjoys huge current account surpluses with the majority of the countries in the world. Clear? Okay. Clear, guys? Clear, guys? Clear, guys? But remember one point. RBI can operate only on the demand side. This is a beautiful introduction point. RBI can repo rate, using repo rate, RBI can only suck out the liquidity because there is no supply. There is no supply in the economy. RBI, what is doing? It is sucking out liquidity in the system. Supply belongs to government. Government is sleeping. Government doesn't have infrastructure in the country. You are develop cold storage facilities, develop transportation facilities, develop warehousing facilities. There are problems in facilities. There is problems with the MSP. And currently Modi government repelled excellent agricultural reforms under the pressure because of political compulsions, okay, pressure of elections from UP and Gujarat. Modi government repelled excellent agricultural reforms. There are problems in MSP. There are problems in warehousing. There is cold storage facilities a problem. Everything is a problem. So supply is affected. Only RBI is operating on the demand side by sucking out excess liquidity to control the inflation. That is not done. To control the inflation, you need to take care of supply side factors. You need to take care of supply side factors. Unless you improve supply side factors, okay, inflation cannot be controlled. But India is a country always try to control inflation by operating from the demand side, supply side. Somewhere we are weak, we are weak, we are weak. Clear, guys? Beautiful slide. Again, I made a lovely slides for you. Listen to my lecture again. You will. This chapter is going to be easy. Okay, you will learn it quickly because Anirvinna prepared a lovely slides for you. Okay. Now, what real exchange rate depends upon what, right? So real exchange rate we discussed depends upon nominal exchange rate and ratio of price level. So when I say ratio of price level means what? Domestic goods, price of domestic goods and price of foreign goods. Okay, price of foreign goods. Okay, nominal exchange rate. Okay, you can also, if you find out real exchange rate, you can also find out nominal exchange rate. So nominal exchange rate is equal to real exchange rate into price of foreign good by price of domestic good. Okay, so this all nominal exchange rate also you can derive by using the real exchange rate. Okay, this is also very important. Okay, clear? Clear? Ria, you were doubt, Ria. Ria, try to understand. real exchange rate is high means, Ria, try to listen to me. Ria, real exchange rate means high means price of import goods and services cheaper than price of exports of goods and services. It means your imports of goods and services more than exports of goods and services. So it leads to current account deficit. I explained so well, Ria. Explained so well, Ria. How come you're getting this doubt, Ria? Check your answer, Ria. Ria, you are listening to me properly. So well, nicely explained. Ria, check your answer. Check your thinking, Ria. Now, exchange rate, just again, given one more lovely expansion, right? Again, a lovely introduction. The US car, assume, okay, it costs $10,000, right? Now, India car costs how much? 9,60,000. Now, you want to compare the price of two cars, right? You want to compare them. You see, their currency is dollar, our currency in rupees. Now, we want to compare the price of two cars, right? Now, how you compare? So, you need to compare means you need a common currency to compare, right? So, how you compare? You need to compare. So assume you need a common currency, then only you can compare. Assume $1 is equal to 48 rupees, right? Then you can say that US car is how much? 48 per dollar means 10,000 into 48. How much? So their car, their car is that's see such huge number, 48, more than 48, 48 lakhs, right? Now you compare India's car. India's car is how much? 9,60,000. So you see that India car, US car is just one of the price of the India car. Okay, so you can exchange two Indian car for sake of one US car. Okay, so you can exchange you can exchange two Indian cars. Okay, okay, you can exchange two Indian cars for sake of one US car. Clear? Now, there are in trading terminals, okay, we use two terms: direct quote and indirect quote. Okay, separate topic. Okay, what is direct quote? Indirect quote. So the trading terminals, they use two terms: direct quote and indirect quote. So in direct quote, foreign 1 unit of foreign currency is expressed in terms of domestic currency. What is domestic currency? India's currency. That is local currency. So how is that? $1 is equal to 75 rupees. Okay, $1 is today, $1 is equal to 75 rupees is a direct quote. Okay, direct quote. So how you derive direct quote? You can derive direct quote by assuming foreign currency constant and domestic currency changes. Domestic currency changes. So this is what direct quote. Okay, now under direct quote, if quote a lower exchange rate implies domestic currency is appreciating. Okay, now indirect quote. Okay, indirect quote, what you do opposite, right? You are expressing one unit of domestic currency is expressed in terms of foreign currency. Okay, 1 unit of domestic currency is expressed in terms of units of foreign currency. Okay, so for example, 1 rupee. Okay, I'm taking only 1 rupee. Okay, now 1 rupee is equal to $0.0135 US dollars. Okay, so if you take 100 rupees, so 100 rupees you take in India, the indirect quote in US dollar is 1.3513. Okay, so while deriving indirect quote, you keep domestic currency constant, you kept 1 rupee constant, and foreign currency undergoes change. Okay, foreign currency undergoes change. This also made it very simple. R60, 4,80,000. Yes. Okay. Hey, this example to explain only exchange rate. Only exchange rate. Okay. Now we'll move to real effective exchange rate. Real effective exchange rate. Real effective exchange rate. You see, this another new term. We discussed nominal exchange rate. We discussed real exchange rate. Now real effective exchange rate. Okay, or ER, not triple R movie, right? Or ER. Okay, real exchange rate, right? Now why you calculate real exchange rate? I want to measure the competitive of my rupee against a basket of major currencies of the world. Or real exchange rate is an indicator of external competitiveness of a country's currency, that is rupee. It is a weighted average of country's currency. It is a weighted average of country currency against a basket of major currencies. Okay, against basket of major currencies in the world. Now, what is major currencies? You have taken US dollar, you have taken Euro pound, you have taken British pound, and you have taken Chinese yuan and Japanese yen. 5 major currencies. Okay, after adjusting inflation. Okay, repeat again. We are considering US. You are measuring India real exchange, India rupee competitiveness. Okay, against US dollar, Euro pound, British pound, Japanese yen, and Chinese yuan. Okay, 5 major countries after adjusting inflation. After adjusting for inflation. Okay. Now an increase in real exchange rate implies that exports become more expensive and imports become cheaper. Okay. Okay. If real exchange value is high, okay, it means India rupee real exchange rate is high means, so for India exports become more expensive. It means exports become more expensive and imports become cheaper. Okay, so it means our rupee value is high. Our rupee value is high. That's why our exports have become expensive. If rupee value is high, imports would become cheaper. So it means India does not enjoy trade competitiveness in the world market. India does not enjoy trade competitiveness in the world market because our rupee value is high. Real exchange rate value is high means our rupee value is high. It why nobody wants our exports. Bye. Okay. And on the other hand, because you're required to pay less for your imports. Okay. So your imports will be cheaper. So it indicates that India lacks trade competitiveness in the world market. Okay. So decrease in the real exchange rate value means India in opposite. Okay. Clear, guys? Manish, I'll answer your question. Manish, US cannot manipulate. US don't use the word manipulate here. I'll explain, Manish. Don't worry. Okay. Sandeep, why you brought about base currency and counter currency? They are not there in your syllabus. Okay. They're not there in syllabus. Okay. They're not there in syllabus. Let us not confuse with these two terms here. Not there in your syllabus. Yes, Tanu. Yes, Tanu. Tanu, your explanation is right. Now, cross rate. It is one more term called cross rate. Okay. Sandeep, you write to me. Okay. Base currency, but I won't not required now, Sandeep. Okay. You text me in the group in Telegram. I'll reply to you. Okay. Not required now. What, Pooja? Pooja, try to understand here. We are measuring. See, we discussed what is nominal exchange rate. We discussed what is real exchange rate. Now here we're discussing real effective exchange rate. Okay, how you calculate that? You have to consider, okay, weighted average of India's rupee, weighted average value of India's rupee against 5 major currencies of the world, that is US, Europe, Britain, Japan, and China. Okay, after adjusting inflation, you need to adjust for inflation. After adjusting for inflation, if real exchange rate value is high, okay, then you say that India rupee is appreciated. So nobody wants to buy India's exports in the world market. And on the other hand, our imports would become cheaper. It means India rupee does not enjoy, because of India rupee real exchange rate is high, we don't enjoy trade competitiveness. I explained so well. Pratiksha, vice versa means opposite. Okay, opposite in vice versa is the word used to explain opposite. I'm clear to all of you. All of you are with me. Good. Now there's one more term called cross rate. Okay. No, generally, I know all countries' currencies are priced in terms of US dollar. But any exchange rate which doesn't follow US dollar, that is called cross rate. Okay. Now you see this. There is cross rate is also followed without considering US dollar. For example, Australian dollar, New Zealand dollar, they have a cross rate. Similarly, European pound and Japanese yen, they have a cross rate. Similarly, European pound and Great Britain pound, they have a cross rate. That is, when they trade, they don't price it in terms of US dollar. That is called cross rate. Okay, clear? Now countries follow fixed exchange rate system. Okay, Fiji, you know that it's near to Australia, right? Kuwait, Morocco, Libya, these countries follow fixed exchange rate system. Okay, and China also, but there is a small difference here. Fiji, Kuwait, Morocco, and Libya, they follow fixed exchange rate system, and these countries peg their currency against basket of currencies. Okay, basket of currencies what? Again, US, Europe, Britain, and China, Japan. Okay, so they follow completely fixed exchange rate system by against basket of currency. But if China pegs its, China also follows fixed exchange rate system, but they peg their currency only against US dollar. Okay, so majority of countries, nearly 99% of the countries or 98% of the countries follow flexible exchange rate system. Okay, flexible exchange rate system, very small percentage. Okay, negligible, not even 1% of the countries only follow 1% or less than 1% of the countries follow fixed exchange rate system. Sindhu, your question I'll answer, Sindhu. Okay, wait. Sindhu, see, after Second World War, okay, US dollar was the supreme currency. Okay, not only supreme currency in sense, they're able to retain their value for a longer period of time. No other country in the world has that much of stability as US dollar. So what happened? IMF considered US dollar is the supreme currency in the world. So all other countries take US dollar as the anchor. Okay, so that's what I'm saying. That okay, after Second World War only. So because of stability of the value, and they're able to maintain stable value. Stable value means no appreciation nor depreciation. They're able to maintain stability of value, and it has become a supreme currency. All countries, okay, all countries now required to measure the value of their currency in terms of US dollar. I'm able to answer your question. Rohan, pegging of currency, I'm going to explain, don't worry. Sneha, rupee appreciation, I will explain again. Don't worry. Don't worry. I will explain. I will not run away from any of your doubts. Tanu, I explained Tanu. Again, you're asking same thing again, Tanu. Okay, clear, guys? Right? So exchange rate, there are two kinds of exchange rate regimes are there, fixed and versus flexible. Okay, flexible is also known as floating exchange rate system. I told many countries follow flexible and floating exchange rate system. Only few countries follow fixed exchange rate system. Okay, now what is fixed exchange rate system? If I peg the value of currency against US dollar, okay, peg the value of currency. Okay, so who pegs the value of currency? By the government of the country. Okay, and I see what is that. If you give me 1 yuan, okay, if you 1 yuan is equal to $0.50. Okay, whether you today, tomorrow, day after tomorrow, 1 yuan is equal to $0.50. But that's not the case in India and other countries because they follow flexible exchange rate system. Today, $1 is equal to 75 rupees. Tomorrow it could be 76 or 74. Okay, but pegging the value of the currency means you are pegging the value of currency against US dollar. That is called fixed exchange rate system, which China follows. Okay, China follows because China is a predominantly export-oriented economy. Okay, China is a predominantly export-oriented economy because the entire growth of China is the outcome of is the reason because of their strong exports, and they maintain their currency artificially low, or they peg the value of the currency against US dollar, so that Chinese yuan value is so lower. Every country would like to buy goods and services from China, and China export sector flourished. And I told exports is part of the growth of the economy. So China started China growth because of double-digit growth because of their exports. So China continues to maintain that. So if anything happens to, so it's actually predetermined level. Now 1 yuan is equal to $0.50 dollars. It's a predetermined. So if anything happens to, suppose if anything happens to their currency, right? Assume suppose Chinese yuan value decreased, right, or lesser. So what happened? Then Chinese central bank sells the dollars. Chinese central bank sells the dollars. If Chinese yuan value is higher, then Chinese central bank purchases the dollars in the forex market. So, but generally value is pegged. So why a peg? So value is pegged. But this is not there in your textbook again. So what happened whenever economy, US economy, Europe economy are hit by recession or slowdown, China's exports are decreasing like anything. Okay, decreasing like anything. Chinese economy is affected if there is a recession, US or Europe, or severe slowdown in the world economy. What is recession, slowdown, depression, no demand for goods and services? At the time, whenever that is happening frequently, China's export sector also getting affected. So that's the reason why China thought, why can't I, like India, focus on the domestic demand? So you see, India is not affected much because of slowdown, recession, or depression in the world economy. Indians continue to buy goods and services inside India. So China also changed their policy. Okay, they're also focusing on domestic market apart from export market. Take on the pegged currency means value of the currency pegged against US dollar. Fixed exchange rate system is also known as pegged currency. I discussed Ria, Morocco, Fiji, Libya. I gave the examples. Okay, of countries which follows fixed exchange rate system. Pooja, I did not understand your question. Kushi, why can't India also decrease the interest rate like US? Not see, don't compare, Kushi. Both markets are different. Okay, see, don't compare. US is a developed country. India is a developing country. They have a well-developed money market and capital market. Okay, India money market is very good. Capital market is developing. Okay, India cannot afford to do that. Right? India cannot afford to do that, and India requires foreign capital. Okay, if I keep India also keeps repo rate 0%, and entire capital will leave the country, and rupee would depreciate. Okay, rupee would depreciate, and India imports so many goods and services, they would become costly. India cannot take that risk. Yeah, your point is correct. Here, guys. Okay. Now I told you, fixed countries which follow fixed exchange rate, they use the term called devaluation and revaluation. Devaluation and revaluation. Okay. Devaluation means what? If China yuan value decreases, it's called devaluation. Okay. Don't call depreciation. Okay, appreciation, depreciation applies to all countries which follow flexible exchange rate system. India rupee depreciated, appreciated. But for China, other countries which follow fixed exchange rate system, if their value of the currency is decreased, it's called devaluation. The value of their currency is increased, it's called revaluation. Okay, so but generally this is but now what is happening, in newspapers, they're writing common. Even for China also, they're writing depreciation and appreciation. That is not correct. Countries which follow fixed exchange rate system, if the value of their currency is decreased, it is called devaluation. If the value of the yuan value increases, it's called revaluation. For countries like India, all US, you take Europe, Britain, Switzerland, all these countries follow flexible exchange rate system. What is flexible exchange rate system? Demand and supply will determine the value of the currency. So countries which follow flexible exchange rate system, okay, if currency value increases, it's called appreciation. If currency India rupee decreases, it's called depreciation. But sometimes I see in newspapers, for every country they're writing appreciation, depreciation, which is not correct. Pooja, beautiful question, Pooja. See, I peg the value of the currency. I peg the value of yuan against US dollar. I only take a call. I only take a call when to increase, when to decrease. Okay. I only take a call if required. Okay. If I think, array, I need to increase the value of my currency. I need to decrease the value of the currency as per the needs of the economy. Okay. As per the needs of the, I take a call. Okay. So as per the needs of the economy, okay, I won't take full account. I'll increase the value of the currency if it's required. Okay, slightly I'll decrease the value of the currency if required. Not to the expectations of the market. Not to the expectations of the market. Pooja, I understand. Answer your question. Pooja, beautifully explained, Pooja, question. Beautiful question, Pooja. Beautiful question, Pooja. I like your question. Okay, China takes the value of the currency. If market forces say, please increase the value of your yuan, they don't increase to the full extent. Okay, to some extent they increase. Okay, because their exports will be affected. Okay, so they increase, decrease, they do it not as per the requirement, only to some extent. Okay, whenever they feel need, they increase. Whenever they feel a need, they decrease. Okay, when they increase, it's called revaluation. When they decrease, it's called devaluation. Okay. Thank you for the PPT, Sneha. Thank you for the compliments. Yes, I take a lot of pain making PPT. Okay. And listen to my lecture. This chapter will be easy. Okay. I made so simple PPT. Okay. Clear? All of you are with me? So I told This very important PPT I'm teaching. In reality, all countries follow flexible exchange rate system determined by market forces of demand and supply. Okay, just I'll explain here. Okay, okay, give me 1 minute. Okay, I'll use a board here so that you can understand better. Okay, okay, so select. I'm using this. I don't know. Okay. I need a pen here. I'm searching for a pen. Oh, I hope this is pen. Look at here. Appreciation. Oh God, this is not allow me. Erase this. Erase this. Select. Eraser. Okay. Text. Okay. I'm writing text here. Okay. Now appreciation. Okay. So appreciation of currency. Okay. Appreciation of rupee. And I'm teaching what is appreciation of rupee and depreciation of rupee. Depreciation of rupee. Okay, try to follow me here. Now today is what? Today is 27th November. 27th November. Look at me. 27th November. One US dollar. $1 is equal to 75. $1 is equal to 75. Okay. Now tomorrow is what? 28th. 28th, it becomes 76. 29th November, it becomes 77. 30th November, it becomes 78. This is called depreciation of rupee. This is called depreciation. Why it is called depreciation of rupee? Because you are paying more rupees to get $1. Okay. Now tomorrow it becomes, assume will change. Okay. We'll change this. Okay, we'll change this. We'll change these values. Okay. Tomorrow, today 75. Tomorrow it becomes 74. It becomes 73 and 72. 30th November. That is called appreciation of rupee. Okay. So what does RBI do? Please follow me here. RBI follows dirty float, dirty float or semi-float. Dirty float or semi-float. What is dirty float, semi-float? So RBI keeps a band. RBI keeps a band. What is a band? Current band they keep is 72 to 76. Okay, 72 to 76. RBI keeps band called dirty float. What is this band? 72, 76. As long as rupee value within the band, within this band. Okay. As long as value is within the band, RBI will keep quiet. RBI will keep quiet. Okay. The moment tomorrow value comes down from 72 to 71 or to 70, then RBI will not keep quiet. RBI will not keep quiet because value of rupee came outside the band. 71 to 70 means what? Rupee is depreciating against the dollar. RBI will sell the dollars. Okay, why RBI sells the dollars? Because they want to bring back the value of rupee within the band. When RBI sells the dollars, to purchase the dollars, you require rupees. So demand for rupee increases. Slowly, value comes back to 72. Okay. Now, assume tomorrow. Okay. Tomorrow. Assume tomorrow where I can write. I'll write here. Tomorrow again. Okay. I'll erase this with the permission. Okay. I'll erase this. Oh, how can I erase this? I need to erase this. Oh God. Tomorrow, what is the band here? Dirty band. So dirty band. What is the band here? RBI maintains band. Oh God. Text. Oh. So what is the dirty band? RBI maintains 72, 76. If rupee depreciates, RBI sells dollars. Okay. No, 72, 76. Sorry. 72, 76, right? Right. If rupee becomes, rupee becomes 77, 78, 79, this is called depreciation. Sorry, I said opposite. Okay. If rupee becomes 71, 70, 69, this is called appreciation. Okay. If rupee becomes 77, 78, 79, it's called rupee depreciating against the dollar. RBI will intervene in the market and sells the dollars. RBI sells the dollars. So RBI sells the dollars to buy the dollars. You require rupees. Demand for rupee increases and value comes back from 79, 78, 76, 77 to 76 within the band. RBI will keep on selling dollars to bring back the value to 76. Okay, 76. Now assume value of rupee becomes 71, 70, 69. So again went below the band. It's called appreciation. RBI doesn't want this also, right? So depreciation means what? If depreciation means what? My exports become cheaper, imports become costly. I don't want that also. Appreciation means opposite. My exports become cheaper, imports become appreciation means what? My exports become costly and imports become cheaper. I don't want that. I repeat again. Depreciation means my exports become cheaper, imports become costly. And appreciation means my exports are costly and imports are cheaper. I don't want that also. Okay, both are problems. So if rupee appreciates to 71, 70, 69, RBI purchases the dollars. Okay, RBI purchases the dollars. Okay, so RBI purchases the dollars. Okay, so RBI purchases the dollars to bring back the value of rupee to 72. So neither depreciation nor appreciation of currency I don't want. I want a stable currency for which I maintain dirty float or semi-float 72 to 76. 72 to 76. Clear? Clear, guys? Clear? Okay, I repeat again. Okay, RBI follows dirty float. Not only RBI, all countries which follow flexible exchange rate system, US, Europe, Britain, Germany, Switzerland, you take on any country, on paper they say demand and supply will determine the value of currency. No, they say we follow flexible exchange rate system. In reality, what they follow is called dirty float or semi-float. Okay, dirty float or semi-float. On paper, they say हमारा currency है ना, demand supply will determine. ऐसे नहीं है बेटा. They say determine the value of currency, but every country they have their own band. Okay, 72 to 76 means what? I will not allow currency to become 77, 78, 79, 80. I will not allow currency to appreciate 71, 70, 69. If currency is depreciating 76, after 76, 77, 78, 79, it's called depreciation. If currency is depreciating, I'll sell the dollars. If currency is appreciating 71, 70, 69, I purchase the dollars. It's called dirty float or semi-float, where RBI interference, central bank interference of every country will be there. Why central bank interferes? Because they want to see that there is no much volatility of rupee against US dollar. Okay, actually you should allow currency to fall. You should allow currency to rise. If you're following flexible exchange rate of currency, okay, if you're following flexible exchange rate means what? You should allow currency to depreciate, whatever value it is. Okay, no. We are saying on paper flexible exchange rate system, but actually in reality we follow dirty float. dirty float or semi-float, where RBI actually sees that value does not appreciate much, does not depreciate much in the interest of the economy. Okay, so on paper we say flexible exchange rate system. In reality, all countries which follow flexible exchange rate system actually follow dirty float or semi-float, where they maintain a band. So as long as rupee value within this band, RBI keeps quiet. Once value started diving down to 77, 78, 79, it's called rupee depreciation. And RBI sells the dollars to bring back the value of rupee to 76. Okay, now 71, 70, 69 is called rupee appreciation. RBI purchased the dollars because rupee appreciation. I don't want depreciation nor appreciation of currency. I want a stable currency. I'm going to ensure stable currency by maintaining dirty float or semi-float. Beautifully explained again by Nirvinda. Sneha, independence time, India has a fixed exchange rate system, Sneha. Okay. Siddharth, appreciation of rupee is not good. If rupee appreciates, my exports become uncompetitive in the world market. Nobody would buy my goods and services. All my export sector will be hurt. And import become cheaper. Now, if imports of goods and services are high and exports of goods and services are low, it would create current account deficit. Clear? Okay. Now we'll go back to the PPT again. Clear, everything explained, right? So if currency depreciates, okay, or appreciates, RBI intervenes, is called soft peg exchange rate, okay? But hard peg exchange rate is the term used for countries which follow fixed exchange rate system. Clear? Now, advantages of fixed exchange rate. Okay, advantages of fixed exchange rate system, right? Now, why China, Libya, or Morocco, Fiji, all these countries, why they follow fixed exchange rate system, right? Now, why I follow fixed exchange system? Now, see, when I peg the value of my currency, I bring stability of my currency against US dollar. When I bring a stability, okay, I know there is no fluctuations of my currency. Okay, there is no currency exchange rate risk. Okay, transaction cost is low because my value of my currency is pegged against US dollar. Okay, so what happened? Any capital from US and Europe will come to my country. Investment will come because I am ensuring stability of the value of the currency. If investment wants to come to the country, you need to ensure stability of the value of the currency. China and all the other countries think that I can ensure investment and minimize the exchange risk and increase the capital inflow by following fixed exchange rate system. Okay, now countries which follow fixed exchange rate system, okay, so for them international trade is very good. They can export goods and services easily because their value is low, and investors would like to invest in the country where the value of the currency is stable. Okay. So if country currency is stable, there is no speculation. Okay, there is no speculation or arbitrage. There is nothing as that because you are giving stable value of the currency. You are giving stable value of the. There is no speculation attack nor there is no speculation or trading of your currency by brokers or who are investors or because we are maintaining stable value of the currency. It's called dirty float. No, शर्म नहीं है आपको बोल रहे हैं, आप बोल रहे हैं flexible exchange rate बोल रहे हो. You're saying flexible exchange rate and you're interfering by keeping your nose and ensuring that that rupee value does not appreciate between this band. It's called dirty float. On paper, you are saying that how many demand and supply will determine the currency. On paper, you are saying, sure, mar rahe ho. Actually, you are interfering the value of currency. That is why it's called dirty float. Dirty float means what? Semi-float means what? Okay, not completely flexible exchange rate system. Beautifully explained, Sneha. Well explained, Sneha. Sneha, RBI cannot follow fixed exchange rate system. Okay, we moved to flexible exchange rate system from 1991. As part of economic reforms, we moved from fixed to flexible exchange rate system. Right? We moved to flexible exchange rate system. Flexible exchange rate system has its own advantages. RBI can follow its own monetary policy. Okay, there are advantages in flexible exchange rate system. Right? And a very few countries, countries which are export oriented, okay, they may follow fixed. In India is not export oriented economy. Why should we follow fixed exchange rate systems, Neha? Ria, central government only involved, Ria. Central government only involved in dirty float. Okay, not government. Central government only involved. RBI is involved. Clear, clear. Now we are discussing fixed exchange rate, fixed rate advantages we're discussing, right? Now fixed rate imposes discipline, right, and country's monetary authority, right? So if you're maintaining fixed exchange rate system, whatever raw material, machinery you import, so what happens? You enjoy low level of inflation. Because India now rupee depreciates, if India imports any raw material, machinery, cost of the good would go up and inflation would go up in the country. Fixed rate system, there is no such problem. There is no such problem because I maintain stable currency and artificially low. So whatever import raw material, machinery from India, Pakistan, Sri Lanka, inflation is not affected. Okay, and if you maintain stable value of currency, it increases credibility of value of your currency in the world market. Okay, so I told you earlier also, government wants stable currency to promote trade, international trade and investment in the country. Okay, that's the reason why, right? Clear? Vandana, I can't read Hindi properly. Please type in English, Vandana. Sorry, Vandana. My Hindi speaking is bad. How can I can't read it, Vandana, Hindi. Okay. Clear, guys? Now, what is flexible and floating? Market force of demand supply will determine the value of currency. I told you, majority of countries follow flexible exchange rate system. Okay, so I told you why India follows flexible exchange rate system. US, Britain, Switzerland, France, or Italy, okay, all these countries follow flexible exchange system because I have an independent monetary policy. I can have my own monetary policy, right? Central bank enjoys its own monetary policy decision, right? And it can decide its own repo rate, and it can, okay. So and if I follow flexible exchange rate system, even I can determine the nominal exchange rate value of currency, right? If I think $1 is equal to 65 rupees and it is hurting my exports, I can change the value of my currency, to see that my value of currency depreciates so that my exports would go up, right? I can change the nominal value of my currency, right? If my value of currency is slightly appreciated against US dollar, I will decrease the value of currency by purchasing dollars in the market so that my currency value, my rupee value would depreciate and my exports would go up. So this point I told, point number three, I don't agree with this point. They say that since country following flexible exchange rate system, you don't require foreign exchange reserves. That is not correct. Foreign exchange reserves are required Yes, more for even flexible exchange rate system, countries which follow flexible exchange rate system, because to protect the value of rupee, if anything, value of rupee against the dollar, okay, we require foreign exchange reserves. Okay, so okay, your textbook is saying this, but in reality, foreign exchange reserves are very important. You write both the points in the exam. Okay, so okay, and but what is the problem with flexible exchange rate system? It's very volatile. Okay, value of rupee keeps on changing, right? So that's the reason we will follow dirty float, and but still, no, value of rupee, fluctuates rapidly. So there's so much of transaction costs are involved, and there's a lot of risk involved, and cost of goods and services will be affected. The rupee fluctuates rapidly up and down, and value of assets are traded getting affected. Okay, so this is the disadvantage. So in short, fixed rate brings more currency, and fixed exchange rate brings more currency and monetary stability and credibility, but lacks flexibility. But lacks flexibility means what? RBI, Central Bank of China, cannot do with regard to its monetary policy independence. On the contrary, a floating rate has greater policy flexibility and less stability. Vandana, my Hindi is so bad, Vandana. You translate. Thank you, Vandana. So sweet. Clear. 10 minutes to go to break. We'll cover 2 more topics today. Time is 7:10 only. Now we talk about foreign exchange market. Okay, foreign exchange market. Okay, okay. So foreign exchange market, where the value of the currencies are supplied and demand and value is determined in the around the world. Okay, now who participate in the foreign exchange market, right? We have central banks, commercial banks, government, foreign exchange dealers, multinational corporations. Okay, they're all involved in the international trade and investments. Non-banking financial institutions and asset management firms, insurance companies, brokers, arbitrators, and speculators, they're all involved in foreign exchange market. Okay, now the role of the central bank is to take care of exchange rate of their respective. Every country wants to take care of their exchange rate, right, to ensure there is no abnormal appreciation or depreciation of currency. Okay, and the value remains within the limit. Okay, that's the reason why they follow dirty float. Okay, so any appreciation, any sharp appreciation, depreciation would hurt the national income of the country, that is GDP value. Okay, clear? Okay, clear, guys. Let me take some water. Okay, now how commercial banks participate in the foreign exchange market? They may participate on their own or on behalf of their clients. And when they trade on their account, banks may operate either as speculators or arbitrators or both. So the bulk of the current currency transactions occur in the interbank market, in which banks trade with each other, right? Commercial banks, how they follow in the forex market. Okay, this all you must have studied through under finance, right? Now, foreign exchange brokers, right? Now, so there are brokers in foreign exchange market. They act as intermediaries between dealers and bankers. Okay, and arbitrators make profit, right? They by discovering the price differences between two currencies, right? So they make profit out of it. And speculators, right? Bull and bears. Okay, bull and bears. They deliberately, they're in stock market. They also make speculative gain. Okay, by about the speculative gain. Okay, and by tracking exchange rates. Now, other participants are individuals. Their number is very, very less. So, regardless of all this transaction, Okay, physical, this is regardless of the physical interaction. So markets are highly integrated. All foreign exchange markets are highly integrated at any point of time. Okay, and exchange rate, you see now exchange rate. You can go to Germany and see what is the value of rupee against Europe pound, US dollar, because entire system is completely integrated, right? So integrated and um, and there is little scope for arbitrage, because the value of the currency is no common across the globe, whether US dollar, Europe pound. At any point of time you can find out how how the value of the currency is changing at every moment. By sitting in Pakistan, you can track India's currency. By looking at Germany, you can track India's currency. Entire foreign exchange market is completely integrated. Neha, if you have a dollar at your home, you need to go to any foreign exchange bank in India, and you need to, and whatever is the value on the day only you would get. Okay, whatever value in the day only you would get. Okay, okay. So Neha, you have a lot of dollars at home. Okay, tomorrow go to any bank, foreign exchange bank, and you can exchange your dollars into rupees. Okay. Yes, according to market. No, tomorrow's value only. Whichever day you go, that value you would get, right? You would get. That's it. If rupee is appreciated, you get more value. Rupee depreciated, you get less value. Clear? So foreign exchange, there are two kinds of transactions are there. Spot market is there. Okay, so where the spot market, what if you give this 74 rupees and they'll give you $1, right? So current exchange rate, right? Now you know that in foreign exchange market there is a forward market, future market, where contracts are executed and currencies are traded for the future dates. This all you are aware of it, right? Okay. Now, the functions of foreign exchange market. Okay. Now, what is foreign exchange market? What do you find? You find huge liquidity, right? Because of various currencies are traded, right? You have a huge liquidity. Okay, and a lot of transparency. You know what is €1 pound value, what is US dollar value, what is British pound value, what is yuan value. So traders, speculators, everybody has a complete access about the market information about various currencies. It is very dynamic, right? And value keeps changing throughout the day. Value keeps changing, and it is 24 hours, right? The trading happens 24 hours in a day. Okay. Now, okay. Now, determination of nominal exchange rate. Okay. So today we are saying $1 is equal to 75 rupees. How we are able to determine the value of the currency? How we are able to determine the value of the currency? How we are able to determine the value of the currency? Right. Now, how we are able to determine the value of the currency? Okay. How we are able to determine the value of the currency? Now, okay. So I told you determination of nominal exchange rate based upon demand and supply. That's what we're discussing. Now, who is demanding? Who is demanding dollars? Okay, okay, okay. Who is demanding dollars? We are demanding dollars. Why? Why? So Sneha's father wants to send Sneha after CA to study MBA in US country. So Sneha's father required dollars. So he has to pay university fee. A CA and MBA is a good combination, right? Now, CA and MBA is a very good combination. Suppose Sneha's father wants to send Sneha to Harvard Business School to study MBA. He requires dollars. Now, assume Manish wants to set up a factory in US. So if Manish sets up a factory in US, it's called foreign direct investment. Okay, foreign direct investment. Now, so suppose you want to buy shares, bonds of US corporates, companies, and government bonds. So then also you require dollars. Suppose you all of you after completing CA visited US, okay, to celebrate your CA. So you are all touring US. So you require dollars, and you want to buy goods and services again, you require dollars. And to import goods and services again, we require dollars. We require dollars. Okay, clear. All of you are with me. Make it so simple. Making it so simple. We'll take a break, sir. Are you there? We'll take a break, sir. Welcome back after the break. And Sneha, you were asking about articleship. The best way to get articleship is you need to get in touch with top reputed chartered accountant firms. They only provide you articleship. Okay. And I said ICAI, right? ICAI means Institute of Chartered Account of India, right? You're all ICAI students, right? I mean that. I never said ICAI. ICAI. I said ICAI, right? I said ICAI. Okay, so get in touch with any chartered accountant company. They provide you articleship, and you need to get good work learned from there, right? So they give you a certificate only for doing a good work, right? So all the best. Pleasure teaching all of you. Okay. So we asked why Indians demand dollars. We discussed, right? We demanding dollars for foreign education. We want to set up company in the US, and we want to buy equity shares, bonds of US. We want to travel US, and we want to buy goods and services in US, and we want to import goods and services. We demand dollars, right? Who will supply? US will supply to us, right? Now, US will supply. Now, how US will supply, and okay, and okay, so how, so who will supply dollars for us? So when we export goods and services, no, they supply dollars, right? When Americans visit India, right, they supply dollars. When Americans buy bonds, equity shares of India, they supply dollars. Okay, an American firm, you see Wells Fargo is there here, and you take McDonald's, you take Pizza Hut, all these companies are, you take Uber, okay, they're all foreign direct investment. Okay, now I'll show you this, right? Okay, let me share you this board again. I'll show you how to draw the diagram. Okay, so let us first let me erase this. Okay, eraser. Okay, let me erase this. Then let me draw the diagram here. So this is okay. This is your y-axis. This is x-axis, right? Now you have a demand curve here. Demand curve slopes downwards. Okay, and you have a supply curve here. Now supply curve here, sloping upwards. Okay, so both of them are intersected here. So that could be your equilibrium point. Okay, that could be your equilibrium point, right? Now let us name this baby. Okay, now this becomes your demand curve. Okay, this becomes your supply curve. Okay, how many units of dollars being supplied and demanded here? 100. Okay, 100 units of dollar or supplied and demanded today. At what price? So at what price? So you have 75 rupees. So 75 rupees. So this is called equilibrium. Okay, this is how supply demand every day. Petrol price, diesel price, silver articles, gold, and many commodity prices. Okay, and including dollar price is determined every day like this. All right, every day like this. Now assume this clear. Okay, this is equilibrium, right? This is equilibrium, right? Now this is right. Clear? All of you are with me? You're able to follow me? And there have been nice teaching well today. Today also, you need to follow me. Now this is equilibrium. Now what happened? Assume what happens? Again, we need to go there. This clear, this clear. Okay, clear. Okay, this clear. This is how determined. Okay, exchange value of rupee in terms of dollars. Right now, assume we'll go again. Assume the demand for dollars increases. Demand for dollars increases. Demand for dollars increase from where? From D to, okay, D to D1. D to D1. Demand for dollars increased. Okay, when demand for dollars increases, okay, what would happen? What would happen? What would happen? What would happen? Your okay, your demand for dollars increases, right? So demand for the dollar increases, rupee would depreciate to 77. So this is called depreciation of rupee. Okay, depreciation of rupee, right? We'll take clear. Yes, yes. Now we'll erase this. Okay, we'll erase this. Now we'll show you something else here. We'll show something else here. Draw. Okay. Okay. This is demand curve. This is your supply curve. Okay. Text, supply curve. This is your demand curve. Both are equilibrium here. Okay, I need to draw again this line. Both are equilibrium here. Okay, so what is the value of text? What is the value of today? 75 rupees. 75. Okay, how many units of dollar being demanded and supplied here? 100. Okay, 100. Suppose supply of dollar increases. Supply of dollar increases. Supply of dollar increases. Supply curve should shift to the right. Supply curve will shift to the right. Put as S1. And supply of dollars increases. So this is called S1. And what happened? The rupee value is appreciates. Rupee value appreciates. Okay. So 70 to 71. Okay. So text message here. 71. This is called rupee appreciation. Clear, guys? Clear. Now let us go back to the PPT. Right? This what? Oh, you are in this PPT. I need to share back this slide here, right? So let me share again, right? No share, right? This one. Clear? Clear. See, this is how we determine, right? Okay, you need to draw this diagram with pencil. Okay, the exam, don't use pen. Okay, possible, draw with pencil, and you need to write y x-axis. You need to write very clearly. If possible, draw with pencil because it looks nice to draw with pencil. Okay. Now, okay. Now look at here. Look at here, guys. Now, this is what we discussed, right? This is what we discussed. This is what depreciation of rupee we discussed. This is what appreciation of rupee we discussed, right? Now, why we discussed? Somebody asked me in the class, right? Why depreciation of currency are both for the economy? Okay, so I told you exports become uncompetitive. Okay, exports become uncompetitive, imports become cheaper, and imports of goods and services more than exports of goods and services leads to current account deficit. And why depreciation is bad? Okay, so exports become cheaper, imports become costly. When exports of goods and services more than exports of goods and services, this may lead to current account surplus. We don't want that also. Okay, we don't want that also. Okay, dirty float, I discussed. Now, determinants of exchange rate. Okay, so this also I will explain through okay, through board. I'll try to explain this so that you will enjoy more. Let us erase this. Okay, text. Okay, capital inflows and outflows. Okay, today 100 billion capital inflows. What is capital inflows? FFI and foreign portfolio investment. What is this? We'll discuss tomorrow. Okay, capital inflows. Okay, and generally capital inflows includes FFI, FPI. We'll discuss tomorrow. I will not explain now. Okay, and FDI. Okay, into India, capital inflows into India, right? Okay. Now capital outflows. How much? 50 billion from India to outside. So what is so more capital came into India now? How much? Plus 50. If it is plus 50, rupee would appreciate against the dollar. It is minus 50. Assume it is minus 50. Rupee would depreciate against the dollar. This is what you need to write. Simply explain. Okay. Clear, guys? Clear. See, somebody asking me here. Ria, in forex market, spot market is there where value of the currency is determined immediately. Sometimes what happened? Traders may go for future and forward contracts, right? So in future date they're going to pay. In future date they're going to pay, or forward date, right? So they fix that I'm going to pay this much of money in 2022 June. That is called forward and future contract. All these are there in the forex market. You don't require beyond this. Okay, future contract, forward contract, all this contract where value of the currency is determined on the basis of flexible exchange rate only. Clear? Okay. No, clear. Let us go back to the PPT again. We discussed one point. So purchasing power parity. Okay. Now 1 pound is equal to 80 rupees. Okay. Now we want to compare the shoes of England and India, right? So one pair of shoes 400 rupees in India, and then it should cost how much? It should cost 1 pound is equal to 80 rupees, means it should cost 5 pounds in England. 5 pounds in England. Okay. Okay. So this is what we'll try to explain again. You'll understand better. Okay. You can use board here. Let us erase this. Okay. So one pair of shoes. Okay. Text. Okay. One pair of shoes. One pair of shoes, how much? Rupees 400. And same shoes should cost in England how much? In England, how much it cost? It should cost 5 pounds. Why 5 pound? Why 5 pound? Since 1 pound is equal to 80 rupees. 1 pound is equal to 80 rupees. Okay. Suppose same shoes cost only 3 pounds instead of 5 pounds. So what Indians would do? Indians would rather prefer to import from England than buy it in India. So if Indians had to import shoes from England than buying it in India, demand for England pound would increase. So rupee would depreciate and against US pound, against England pound. Clear, guys? Okay. So repo rate, this one we discussed again, repo rate. Okay, let us again, I use whiteboard here. Okay, let us erase this. So what is repo rate in India? So repo rate. Repo rate is how much currently in India? 4%. Okay, 4%. And US short-term interest rate is now assume 0%. And tomorrow US Fed increased from 0 to 2%. 2%. Okay, US dollar currency value is high, no? So the moment 2% it is increased, immediately what investors will do? Investors will take out their money from stock market and go to US. So rupee would depreciate against the US dollar. Clear? Clear, guys? Clear? This is what I'm saying, repo rate. So clear? So the moment repo rate is 2%, because $1 is equal to high value, compared to India rupee. So investors take out their money and put their money in US stock market. So rupee would depreciate because they want the dollars back. They go to stock market, please give me your dollars back. I don't want to keep your money in your country. Returns are low. US short-term interest rate has gone up. I will invest the country. The dollar value is high. So they take out their money. They want dollars. They want dollars back. So they take dollars, put in US economy. US stock market, dollar would appreciate, rupee would depreciate. Clear? So this one. Okay. Now next is inflation. Inflation. India inflation is how much? Inflation is assume it is 8%. India's inflation, assume it is 10%. And US inflation is assume it is 2%. Assume 2%. So inflation in India is high, means returns are low. Again, investors take out their money from India and go to US because inflation rate is low in US. So they take out their money. Once they take out their money from stock market, rupee would depreciate against the dollar. Clear? Clear? So let us go back to the slides. Okay. So I discussed everything, right? Now fiscal deficit. Now if India fiscal deficit is high and India current account deficit is high, I told you in one of my classes that credit rating agencies, Modi, Fish, Standard & Poor, they'll downgrade the economy. The moment they downgrade the economy, that India is not able to pay their debts and they're not able to pay for their import bill. So once they downgrade the economy, investors again take out their money from the stock market, would start investing in US. Again, in rupee would depreciate against the US dollar. Yeah, short term. I told you US repo rate is called short-term interest rate. In India, it is called repo rate and short-term interest rate. The rate at which our central bank lends money to commercial banks. In US, it's called short-term interest rate. In India, it is called repo rate and short-term interest rate. Clear? Clear? Okay. Okay. Now, impact of okay. So, impact of exchange rate fluctuations on Indian economy, right? What is impact, right? We're talking about both depreciation and appreciation, right? So, I told if rupee appreciates, exports good for exports, bad for imports. Okay, bad for imports. Why bad for imports? India imports so much of raw material, machinery. India imports so much of gold, oil. So it's bad for imports. Exports become costly. Imports become cheaper, so if India imports of goods and services more than exports of goods and services, it may lead to current account deficit. Okay, rupee depreciates, right? And what happened? The value of our export goods and services prices will be lower because of rupee depreciation. It may increase our exports. It may increase our value of exports. It may increase our volume of exports, not value. Volume. Volume wise, our exports are high. Value wise is low. Value wise is low because rupee got depreciated. Our volume would increase. Value wise, it may be low. Okay. Now, if rupee depreciates, right? There are so many companies, top-notch companies, they borrowed through ECB, external commercial borrowings, Okay, they borrowed outside India, right? So when they borrowed outside India, why they borrowed from outside India? Because the interest rates, lending rates in other countries are lower than India. Since India always repo rate is high, when US Fed is keeping interest at 0%, Japan keeping the short-term interest rate negative, Europe keeping 0% interest rate. So it is easy for the companies, top-notch companies, to borrow outside India than inside India because repo rate is high. So when they borrow outside India, when they need to pay the principal and rate of interest, and if rupee depreciates, the cost of repayment of debt would go up. Okay, the cost of repayment of debt would go up. Okay, so RBI is saying that all the companies, Are Baba, why don't you hedge your currency? When you borrow outside India, please hedge your currency. So if you hedge your currency, cost of repayment of debt will not go up if rupee depreciates. So RBI kept on saying, please hedge your currency. But unfortunately, our corporates don't want to hedge their currency because hedging is a costly affair. Once you hedge your currency, then you can't withdraw. Second thing is, all corporates in the country think that somehow RBI will stabilize the value of rupee. There will not be rupee depreciation. So they keep on borrowing heavily outside India. If rupee depreciates, cost of repayment of debt would go up. Okay, beautifully explained. Beautifully explained again. Anirvedna here. Okay. So RBI says, please hedge when you borrow, please hedge. But our corporates think that it is RBI duty to maintain stability of the rupee. RBI will maintain. Why should I hedge? Hedging is a costly affair. And once I hedge, I can't withdraw from hedging. So corporates always depend upon RBI. You take care of the rupee value. I borrowed heavily from outside India. I want to repay. Okay. Now government also borrowed heavily outside India. So they also need to repay the debt. So depreciation of rupee creates problem for the government debt outside India, for corporates which borrow outside India. Okay, so clear guys, all of you are with me. Okay, all we discussed so well. So rupee depreciates, what happened? India imports so much of raw material, machinery, equipment, then cost of production would go up. And cost of production go up, nobody would buy our goods and services. When nobody buys our goods and services, and the value of national value of our national income will go down. Nobody would buy our goods and services. Clear? Clear, guys? Clear? Okay. Rupee depreciates. I told you, foreign goods become expensive in the country. So if rupee depreciates, what happened? Indians would say that we'll import from USA and then buying it from India. Okay, if rupee depreciates, what happened? Foreign goods would become expensive. So people in the country think that I can't borrow from outside India, very costly. So I'll buy it from India. So when they buy it from India, in rupees only I have to pay, no. So they demand goods and services in India. It might create expansionary effect, resulting in increase in investment, output, employment. If people buy only goods in India, what happened? It will have an impact on the investment, output, employment, and national income of the country. Okay, so one way it helps. Rupee depreciation may help the country, because people don't import from outside India. They buy goods and services and pay rupees only. So it will create a favorable effect on the output, employment, income. People, so looking at the more demand for the goods and services inside India, companies also produce more. Output will increase, employment increase, and output means GDP. GDP nothing but national income growth. Everything will increase. Okay. So if rupee volatility is high, I told you that investors will take out their investment in the economy. Okay, invested in the bond and equity market. Okay, and okay, clear. Okay. If rupee depreciates frequently, no, the firms cannot forecast their cost and revenue easily, because there's a lot of risk and uncertainty involved in investment also, right? So I can't forecast my cost and revenue. I can't think of my investment of the company. Okay, and I told you hedging involves huge risk and cost. Okay, okay. So when repayment of debt comes, no, and if suppose India RBI doesn't have enough foreign exchange reserves, okay, and again it creates a problem for the repayment of debt for the companies. Okay, clear, guys? Okay, clear, guys? Now we're discussing these implications, right? If rupee depreciates, right? India imports oil, gold, and other commodities, raw material, equipment. So there are you know what happened when rupee depreciates means we're paying high cost for raw material, machinery, equipment, and oil. Then what happened? Our inflation rate also would go up, because CPI includes import prices of imports of goods and services, raw materials also. Okay, now, okay, okay, if rupee appreciates, right? So what happened? Our exports become costly. Nobody would buy our goods and services. Imports would become cheaper. So imports of goods and services more than exports of goods and services. So resulting in no current account deficit. So current account deficit, again, I told you, no, credit rating agencies, Standard Poor, Modi, Fish, they will not like that. Okay. But depreciation of rupee might help India, because Indians love gold. No, Indians love gold. Okay, so it might help India to contain the import of gold. Okay, so in the process, it might help India to control its trade balance. What is trade balance? Trade balance includes only imports and exports of goods only. Current account includes both goods and services. Okay, so depreciation of rupee also may help India, to control the trade deficit, because exports would increase and imports would become costly. So India can control their trade deficit, because our exports would increase. Okay, and appreciation of rupee. If rupee appreciates, what happened? And our machinery, equipment, raw materials, oil, gold, all these commodities would become cheaper. Okay, and it might help India to control the inflation rate. So if rupee is depreciating, what does RBI do? RBI requires foreign exchange reserves to protect the value of rupee against the dollar by selling dollars in the market, open market. Clear? Okay. What do you say? Let us take the questions. See, Shashank, what are the manipulated economic measures? See, there is no manipulated economic measures, right? See, dirty float is a kind of a manipulation only, right? if all countries follow flexible exchange rate system and on paper, but actually they follow dirty float, is a kind of a manipulated measure only. Mridul, I'll upload the PPT. Mridul, don't worry, I'll upload. Okay. And Sneha, sir, one question: if you deposit money at 4% interest rate, but after 2 months, interest rate increases to 5%. See, Sneha, try to understand here. We're not looking at interest rate here, Sneha. See, we compare the, suppose you are deposited 100 rupees, right? You're going to get 4 rupees. If rate of interest increased to 5%, see, you deposited money in what time? January 2022. Okay, rate of interest is increased to in the month of June, right? So from June to December, again they calculate your balance 5% rate. They won't give you overall. First 6 months they'll calculate 4% interest. Other 6 months they calculate 5% interest rate. Then they give you interest rates on your savings account, that is known as deposit rate. But actually, we need to consider rate of inflation. Suppose you were on savings account, you got 5% on 100 rupees, 5 rupees, and the rate of inflation is 7%, right? Now, what is the real interest rate? Real interest rate is negative, minus 2%. That is how we calculate. Clear, Sneha? Ria, India follows, all countries follow flexible exchange rate system where demand and supply will determine the value of currency. But in reality, they follow dirty float, semi-float, where RBI tries to ensure that rupee value does not appreciate too much. Clear? Clear, clear. Clear, clear, all of you clear? Clear, guys? Clear? Okay. So let us take a recap. So we're discussing exchange rate chapter. Okay. We discuss what is exchange rate, simple meaning of exchange rate. We discuss what is nominal exchange rate, right? Then we discussed real exchange rate. Real exchange rate considers prices of domestic goods and foreign goods. Okay. Then if real exchange rate is high, low, we discussed. And I also discussed real exchange rate depends upon nominal exchange rate and the ratio of price level of domestic goods and foreign goods. Then we try to derive what is nominal exchange rate, right? Clear? Okay. Now, and okay. Okay. Then we discussed. We compare the exchange rate of price of car in US and India, and direct quote, indirect quote we discussed. Okay. Direct quote, indirect quote we discussed. And we discussed what is direct quote, indirect quote. Okay, another different topic. Okay, and we discussed real effective exchange rate. Okay, to measure the competitiveness of rupee against a basket of 5 currencies. Then we discussed cross rate. Okay, now we discuss countries follow fixed exchange rate system. Okay, and we discussed fixed and floating exchange rate. Okay, with example I discussed. Then I used the term devaluation and revaluation of rupee. Devaluation, revaluation of rupee. Okay, and devaluation, revaluation of rupee, and I discussed depreciation versus and appreciation of rupee. Devaluation, revaluation is used in fixed exchange rate system, and depreciation, appreciation of rupee is used in under flexible and floating exchange rate system. Okay, and we discussed dirty float here. Okay, countries which follow flexible exchange rate system, the RBI intervenes. That is called soft peg exchange rate. Countries follow fixed exchange rate system. RBI intervenes. It is called hard peg exchange rate. Then we discuss so many advantages of fixed exchange rate system. Okay, and we discussed flexible exchange rate system and its advantages. Okay. Okay, then we discussed about foreign exchange market. Overall, the participants that we discussed. Okay, these are the various participants. Okay, then we discussed foreign exchange market, two types of transactions, spot, forward and future markets. So you don't have much of deep of this. Okay, basic only you have. Okay, then and the functions of foreign exchange market we discussed: high liquidity and market transparency and dynamic market and 24 hours we discussed. Okay, then how nominal exchange rate is determined we discussed. So okay, and we discussed, and so why Indians demand dollars, so we discussed, and who will supply dollars for us also we discussed. Then exchange rate is determined. Okay, what would happen if demand for dollars increases? Rupee would depreciate. Okay, then what would happen if supply of dollars increases? Rupee would appreciate. We discussed. Okay, why depreciation and appreciation of currency are bad for a country? We discussed. Okay, and we discussed all again what is dirty float. Okay, and factors determining exchange rate of a currency, that is India. You can take any country. So capital inflows, purchasing power parity, short-term interest rate, that is repo rate, inflation, fiscal deficit, current account deficit, all these factors determine the exchange rate of a country's currency. Okay, now, and we discussed what would happen if there is a fluctuations in the appreciation and depreciation of rupee. Clear? Clear? Okay, we discussed all the factors. Okay, now true or false questions, right? All flexible exchange rate regime countries follow dirty float. What is your answer? What is your answer for the first question? All flexible exchange rate system regime countries follow dirty float. Pooja, I told you countries on paper flexible exchange rate system, their demand supply actually determine the value of the currency, but still they follow dirty float or semi float. Clear? All countries, all flexible exchange rate regimes follow dirty float. Say true or false. I'm waiting for your answer. Nobody's answering me here. All of you are with me today. True, right. If rupee depreciates, RBI purchases the dollars. Second question. If rupee depreciates, RBI purchases the dollars. Second question, please. Second question, rupee depreciate, RBI purchase the dollars. False. Okay, real exchange rate low, it means foreign goods are expensive. You need to answer me quickly. Third one is true. Okay, purchasing power parity determines the exchange rate. Yes. Repo rate is linked to exchange rate. Yes. Clear? Clear, guys? Let us take few questions here. Discuss the different types of exchange rate receipts. Okay, I need to correct this. Types. Okay, I'll correct. How is exchange rate is determined under floating exchange rate system? How changes in exchange rate affect the economy? What are the various determinants of exchange rate system? Okay, we discussed. Differentiate between nominal and real exchange system. How do you determine the strength of the currency? Write a note on forex market. Discuss the advantages of fixed and flexible exchange rate systems. Clear? Clear, guys? Clear? Any doubts with me? All of you are able to follow me. Able to follow me here? Are able to follow me, all of you? Now let us take few MCQs. Real exchange rate considers, first one, relative prices of domestic goods. Oh, I need to increase the size, right? Real exchange rate considers A, relative prices of domestic goods, relative price of foreign goods, relative price of essential goods, relative prices of domestic goods and foreign goods. Yeah, regimes is a kind of a types. Okay, somebody asked me to explain forex market again. Let me give one. Let me. Somebody asked me to explain forex market again. Where is forex market? See, forex market, okay, currency market, forex currency market, where exchange rate for various currencies are determined. Various currencies were not only India, every country currency value is determined. So who are all the participants? Central bank, commercial banks, government, foreign exchange dealers, multinational companies, all these people, internet, the non-banking financial institutions and asset management companies, insurance companies, brokers, arbitrators, speculators, all this they play a very important role, right? So India Central Bank also is also one of the participants to see that rupee value does not depreciate much and within the band. Okay, that's what we discussed. Then we discussed overall. I'd explained again commercial banks, what commercial banks does. Okay, commercial banks might act on its own or on the basis of on behalf of their clients. The foreign exchange brokers, arbitrators, speculators, other participants, everybody would participate. Everybody has their own role in the foreign exchange market. Clear? Okay. So in foreign exchange market, there are two types of transactions: spot market and forward and future. Spot market means current exchange rate of as per the current exchange rate of rupee and US dollar. Future forward contract means of the contract executed by the two parties, buyer and seller, right? So for future date and for future market and forward market. Okay. So real exchange rate, first question, what is the answer? First question is, answer is D, relative price of domestic goods and foreign goods. Vandana, right answer, Vandana. Keep it up. Your real exchange rate is high. Okay, real exchange rate is high. Real exchange rate is high. What is real exchange rate high means? Second question, you need to answer me. See, arbitrage, somebody, they see any price difference, right? If suppose in one market value of the currency is low, okay, so they buy that currency and sell it in the market where the value of the currency is high. So they make the kind of gains. They see the price difference of currencies and they'll buy and sell. Nishank, your question I did not understand. Real exchange rate is high means what? Foreign goods are cheaper and imports will rise. Okay. Third question. Under floating exchange rate system, floating exchange rate is determined by A, value of currency of a country is pegged. Market forces will determine IMF and World Bank. So we know that market force of demand supply will determine. If the rupee is depreciating against the dollar, RBI will sell the dollars. RBI will not. Okay. Which of the following is not determinant of exchange rate? Okay. Inflation, capital flows, repo rate, and consumption. What is the answer? Fifth one. Fifth one. Fifth one. Third is a B, right answer. Good, Kushi. Kushi, second is A, Kushi. Sneha, which is third B. Okay. Second is A, Pooja, right. Fifth one I'm asking, fifth one. Fifth is D, right. Who said this? Shashank, good reply. Kushi, your answer right. Vandana, keep it up. Ria, how come you got it wrong, Ria? Fifth is D. Sixth one. Your real exchange rate is high. It might lead to. Who will answer? Sixth one. Real exchange rate is high. Real exchange rate is high. Current account deficit, fiscal deficit, current account surplus, increase in foreign exchange resource. Answer me, sixth one. Sixth one, answer me. Sixth one. Sixth one, no one is answering. Sixth one. Sixth one, no one is answering my question. Kushi, your answer is right. Kushi, Pooja, your answer is right. Kushi, your answer is right. Rupee is appreciating against the dollar, then RBI will. Seventh one. Seventh one is A. Right. Right, Ria. Pratiksha, you mention the question number, Pratiksha. Okay. Which of the following statement is false with regard to rupee depreciation? Who will answer this? Eighth question. Which of the following statement is false with regard to rupee depreciation? Eighth question. Who will answer? Eighth question. Sneha, tomorrow class is there. Eighth question. Who will answer? Which of the following statement is false? No one is answering my eighth question. Siri, your answer is incorrect. Shashank, I think your answer also incorrect. If rupee depreciate, capital will come to India. It will not come. Capital will go out. So 8 is B. B. Oh God, tough question. Nobody answered here. 8 is B. 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 Rupee is depreciating. Why will capital come to India? No, that is false. Terms revaluation applies to. So term revaluation applies to which country? Fixed exchange rate system. 9. Yes, 9 is correct. Ria, your answer is right. Now, 10th one. Which of the following statements is false? Oh, tough question. Which of the following statement is false? Which of the following statement is false? Which of the following statement is false? Last question. I'm looking for your answer. So the following statement is false. Which of the following statement is false? Which of the following statement is false? 10th one. So 10th one answer is dirty float generally followed by countries with fixed exchange rate system. That is false. That is false. So false. 10th is D. So my humble suggestion for you is I'll upload the PPTs and everything. Don't worry about that. Now my only suggestion is one of my student, MBA student, after CA did MBA. So she drawing some 13 lakhs package in Deloitte company. Okay, I'm not saying that CA MBA is a good combination. So communication skills is very important. That our girl name is Sneha. She did CA, then she did MBA. So CA and MBA is a good combination. If you want in future, you can do with CA also, nothing wrong. And second thing is, some of the CAs in the market, and they're learning Power BI. Power BI is called Power Business Intelligence course. Okay, so they now you need to learn advanced Excel, Power BI, not now after completion of CA. So market wants CA plus Power BI, Power Business Intelligence. So there is a course that's called Power BI. You can refer this course in Coursera, but this course you should need to learn. You need to learn advanced Excel. You need to learn advanced Excel. Okay, or so market wants CA plus. Okay, they don't want CA plus. You need to have some extra skill, advanced Excel, Power BI or MBA. So what is advantage? You can get a good position in a company. Okay, no, if you want to practice chartered accountancy, you don't require anything. But what is happening in the market is most of the CAs, chartered accountants, they don't know how to operate advanced Excel, because everything Income Tax Act and everything, income tax filing, returns, and everything is now being used Excel, right? So you should be thorough with Excel, right? Even if you want to practice chartered accountancy, you should be good at CS. There are many of my friends who did CA long back. Now they're all struggling, kabaddi. So they say that, sir, we're not able to, we're not good at Excel. So you need to learn Excel, advanced Excel and CA. So CA, along with CA, you need to learn advanced Excel. There is a program called, you can refer Google, Power BI. Okay, Power BI is a course. Okay, so companies are asking this kind of skills. Communication skills is very important. Okay, communication skills are important, and communication skills something you learn only by speaking English. Okay, we need to speak, and my Hindi is very bad, and so I teach only English in the class, and so English is very important. Writing skills, speaking skills. Okay, so along with CA, you plan something else in the future, and future is become so expectations are rising from the industries. So they want many things. Okay, they want many things. Okay, they don't want any basic degree from you. They want something else, something more from you. Okay, so you need to plan, and you need to plan, study well, and especially a chapter like international trade chapter, which I taught you a few days back. Better write the answers without seeing the book, without seeing the thing, because international trade, the specific duty, all these duties you need to remember. So some of the practice it regularly, and market has become so tough, and become so tough, and do in articles association a good chartered accountancy firm. Okay, don't join your from papa's friend. Okay, join a chartered account company where they give you a lot of work. Okay, they should make you to sweat. आपको ज्यादा काम देना है, आपको ज्यादा काम देना है, आप ज्यादा काम सीखना पड़ेगा. Okay, so study, work hard, and work very hard. Okay, and CA is a very good course, but If you think of CA plus something else, I want to do extra along with CA, nothing like that. It's too early for you. First to complete CA inter, and after CA completion or during the last part of CA final group, you can think of what is my plan, whether I want to do CA practicing, or I want to join a company, or I want to do something else. Okay, so market is no, they're asking extra skills. Okay, they're asking extra skills for everything. They want extra skills because there are so many CAs in the market. So what specialty you would bring for me? What specialty you would bring for me? So I'm telling because of my student Sneha. So she got placed 14 lakhs or 13 lakhs in Deloitte. Okay, and my MBA students got the package of 5 lakhs, 6 lakhs only. They didn't get the good package because they have just only MBA. They don't have MBA plus. They don't have MBA plus. But Sneha joined after CA. She joined MBA. 2 years she worked. Okay, 2 years she studied MBA, and companies love this combination, no, MBA and CA. Okay, they love this combination. Okay, CA and MBA is a very good combination. Okay, nothing like this. I'm not saying that all of you do CA, but companies are asking some skills extra, either Excel or Power BI or Tableau or programming. Okay, so you please learn Excel. Okay, all of you need to learn first. Before inter, I want all of you to learn advanced Excel. Okay, so okay, सब लोग advanced Excel सीख लो आप, because Excel is very important. Because without Excel, no, you can't work in any CA firm or any CA company. Before you go for articles association, please learn advanced Excel. Okay, it takes 1 or 2 months. Okay, 1 month at least learn normal Excel, then try to learn advanced Excel. Excel is very much required. Okay. If you don't, some of you don't feel like studying, see, my suggestion is, you need to analyze yourself, right? So you study a subject which is more interesting for you. Okay, you study a subject which is more interesting for you. Suppose you like accountancy, do accountancy, study accountancy first. What happens? Blood will flow in your mind to mind, and mind becomes active. Then you study subject which you don't like. Okay, and so see, if you're not interested in study, means you need to analyze yourself, right? Why it's happening to me? Am I sleeping well? Am I eating well? Okay, I'm eating well. So is there any problem in understanding? Okay, first study the subject which likes you most. Then आपका mood अच्छा होने के बाद study a subject which you find it difficult. Okay. And CA and MBA, you can try MBA. Do an MBA in a good institute. Okay, I'm there to guide all of you because I'm MBA faculty only, right? So market wants something extra. They don't want CA. They want something. CA, if you do, you can practice, no problem. But if you want to do, if you want a job in a high career job, high paid job, then they want something else. Okay, I told you that girl is Sneha from Jaipur, right? That girl, my student only. Okay, I'm surprised. First day she told me, "What are you, Sneha?" Sir, I'm a chartered accountant. I thought she's joking with me. Actually, she's CA, and she did MBA. She applied for Deloitte company. They've offered her 14 lakhs straight away. Okay, she's working for Deloitte. Okay, starting salary 14 lakhs for Sneha. Okay, I'm always there. Study well, study well, study well. Okay, okay, can we sign off? Thank you. Okay. Sir, are you there, sir? Sir, we can wind up, sir. We can wind up, sir. Hello. Thank you, sir. Can I leave? Thank you. See you tomorrow, 10 o'clock, sir.